This is very much about the global economy and how much impact the coronavirus will have. Will the global economy slow down enough to warrant the kinds of moves we've seen in the marketplace?
I don't think so. I think the global economy is slowing, certainly, and people are going to have to be taking down their growth forecasts. But at the same point, I think we've seen a heck of a lot of selling, and relative to, I forget who you had on earlier, but they were noting that the selling is just kind of completely random. And I think when people are just trying to get liquidity and they're not thinking about what they're selling in order to raise the liquidity, I think that's a sign that maybe things have gone a little too far. Now, when you say liquidity, again, it's been brought up a lot today. How much do you think the market action has been driven by that liquidity or lack thereof? As opposed to, like, say, fundamental issues with the economy? So I'm not an expert on equities, but I think there's a decent chance that some of what we're seeing in the equity market is just equities are liquid. And so if you want to raise cash, you go for the liquid asset first. It might not be the asset you actually want to get rid of. You're going to take some time to actually rotate out of the assets you want to get out of, given the liquidity that's available in those assets at the time. Do interest rates these days, Drew, accurately reflect in your mind what's going on with not just the coronavirus, but the ultimate ripple effects on the global economy? Or is it too central bank intervened and artificially manipulated for it to be a reliable indicator? So the yields we're seeing now are the yields we would have anticipated seeing if we had a U.S. recession. So our view was that a U.S. recession was coming. It was going to be in 2021. Maybe you're pulling that forward and lengthening the recession a little bit because of the impact of the virus. But, I think it's a little too early to say that this is a done deal. And so you would expect to see actually maybe slightly higher yields, even given everything that's going on. All right, let's broaden this conversation out. So let's bring in Jenny and also Anastasia as well. Jenny, we'll start with you here on this particular point. One of the reasons why many of the banks, including Anastasia's, have kind of looked at lowering their targets near term and keeping their targets more in check for the market has to do with interest rates. Has to do with this idea that with low rates moving the way that they are and then maybe rebounding a bit, you'll see some price action there. How much do interest rates factor into your thought process for valuing equities at this point?
I would say, if anything, they weigh in a really positive way, right? Because again, as someone who looks at dividend income, suddenly bonds are way less attractive. So if I'm constructing a portfolio, if people are constructing portfolios, then what are they going to get? Like 1%, 1.5%? Suddenly, the 5% on IBM, the 6% on AT&T looks a lot more attractive. So for me, those low interest rates are actually positive.
Yeah, you're also, Anastasia, looking at the credit markets as well. Yeah. And the trade ideas have to be flowing for you because that's what you get paid for. So what exactly are you looking for in terms of how you play this?
That's right. So I'm looking for two things here. So first of all, you've noticed that in the last week, the 2-10 curve has actually started to steepen, which is a little bit counterintuitive because you think flight to safety, the curve flattens. But the reason the curve started to move higher is because you've got expectations for central banks, for the Fed to cut rates now. And so if you think about positioning for, a steeper yield curve, this makes sense from two perspectives. Because on the one hand, if you have this thing that is actually not contained and, the recession scenario is plausible, then guess what? The Fed is likely to cut rates, and that would steepen out the yield curve. On the flip side, if this thing is contained in a month or two time, then you could have the yield curve steepen out as well because, to Drew's point, we're going to start to reprice those recession probabilities that are baked in the 10-year yields right now. And so the long end of the curve, the 10-year, could actually go higher. So I really like that. And the second thing is, this is a little bit too late to be adding protection in the equity market.
Sure.
Because what the volatility is doing there. But if you look at the credit markets, there is a way to buy protection against wider credit spreads.
You're talking about credit default swaps. It's bond insurance in essence.
In essence. And if you look at that chart, yes, the credit default swap spread has widened, but it's not where it was earlier in 2018, and it's not where it was in 2015, 2016. So those credit spreads have been behaved too well. They could go wider.
So, Jenny, I mean, we just had Bill Stoxx talking about the high yield markets as well. One of the things we didn't get to point out was that spreads can widen out a lot more than they already have so far. Does it worry you on that front?
No, I don't think that worries me either. Can I ask Drew a question?
Yeah, absolutely.
Okay, so here's a hypothetical. One of the things that I've thought about so much is as the banks have been lowering their forecasts, a lot of this hinges on assuming that the consumer is going to just shrink and step back. But if people are sitting home, and you think about all the bricks and mortar, the reason they're suffering in the first place, right, is because everyone wants to shop from home. If people stay home, do you think there could be a positive surprise on all of this, that actually the consumers continue to spend and actually these super low interest rates mean people are shopping for cars from home and they're going to go buy them later, they're more comfortable buying houses? Do you think that ends up being maybe a silver lining?
I think that works to a point, and I think what you're seeing right now, though, is the concern that that's going to stop working because the one thing you can't do, and it's the reason why we don't think the Fed's going to move yet, is because if people are afraid for their lives, they're not going to go out shopping. They're not even going to stay at home and shop. They're going to bunker down, and they're going to only buy what they need to buy because they're going to be afraid that they're not going to be able to get to work, that their job isn't going to exist when they get back to work. There are all these fears that then become to come in and impact consumer spending. And I think that's what people are worried about. We haven't seen it yet, but that's the next stage is factories are shut down and then like, oh, I'm out of work and I don't have the cash flow I need.